I'm Dina Al-Yacoubi Masri. I'm Senior Wealth Manager at Holborn Assets, and I am a family legacy strategist specializing in the preservation, growth, and smooth transfer of wealth to next generations for family wealth as well as businesses or partnerships. I come from private banking background, and I have been in the banking profession since 1999, which is plus or minus 25 years. And I worked in leading organizations starting from Emirates NBD, then Citibank, and then Barclays Private Bank. Today, I'm at Holborn Assets, which is a worldwide financial services company with offices in 18 countries. We have more than $2 billion of assets under management, and we serve over 20,000 clients all across the globe. At Holborn, we work under the DIFC license, the Dubai International Financial Center license, which is one of the highest regulated authorities. At Holborn, we have an open architecture platform that allows us to match clients' needs and to offer the most suitable services and products. We deal with companies that are biggest in their game. In other words, we deliver external products and services to our clients. And that means that we act independently in the best interest of our customers to allow them to meet all their financial needs. As a legacy strategist, I work with high net worth individuals to customize their investment objectives. My work is geared towards legacy building, which is creating a multifunctional solution for capital growth coupled with capital protection and smooth transfer of wealth for future generations. Obviously, every client has his or her special and unique circumstances and family business dynamics that need to be addressed. From my experience, I'm going to share the very typical examples that I have addressed as clients' needs. Clients are looking for a way to diversify away from their business exposure. They're looking for a way to diversify away from regional, political, and currency risks. They're looking for a way to secure smooth intergenerational wealth transfer in the event of loss of key owner, investor, or partner. They're looking for a way to smoothly cash back their monies. They're looking for a way to create a structure that will provide income for retirement and for family members or key persons. They're looking also for a way for estate planning, a structure that will protect the wealth for the next generations and secure the interests of certain members, obviously in absence of conflict. Forced heirship is a major concern for most families. They're looking for a structure that allows them to move away from forced heirship. High net worth individuals' inheritance will be decided by the law of the country in which they live and hold these assets in. Forced heirship takes place in Muslim countries, Italy, France, Spain, and Japan. Excuse me. Oftentimes, there is the requirement to meet their income needs to supplement ongoing requirement for liquidity. And high net worth individuals are looking for a structure to help them manage their multi-jurisdictional and complex structures across the globe. In essence, clients are seeking peace of mind. Amongst many others, our sophisticated offshore structure solutions address the following challenges. Business protection. A structure that can provide key person protection and pay out a cash benefit to a business if a key employee passes away. The plan can also be converted to a gratuity payment for employees. Wealth protection. A structure to protect onshore wealth from local collapses. We've seen that happen in Lebanon, in Syria, and in Egypt. In parallel with that, there is the concern for currency protection against local collapses. Then there is the preservation of the value of your estate by providing liquid funds for dependents or a spouse to pay for any fees or debts outstanding upon death. A plan that will preserve wealth and ensure fair and equitable distribution of your estate. What we are going to be talking about today is the multifunctional solution to preserving wealth and creating a bespoke succession plan. And in it, there will be a master trust, there will be protection, there will be succession planning, there will be estate planning, and much more. All that and more will be found in an IUL, which is an Index Universal Life, which is a combination of cash value buildup coupled with insurance. An IUL allows for cash value growth through an equity index account, typically the S&P 500, that has rendered over 9% annual return since its inception. For IUL, we deal with companies that are the biggest in their game. They are Fortune 500 companies. They are more than 100 years old and with world-class ratings, the best companies absolutely in the world. We therefore provide our clients with security, predictability, and trust. With an IUL, you'll be creating one more liquid asset in your balance sheet. You will leave large cash amounts as legacy to your loved ones, your family, and your lenders cannot touch your BVI domiciled monies, your portfolio. Only your beneficiaries can. If you have any questions, please put them in the box and we'll answer them at the end of the presentation. Thank you very much. I will end it by here myself, and I hereby welcome my business partner, Mr. Richard Williams, who is an expert in IUL, and he will walk us through the specifics and the nature of an IUL. Welcome, Richard, and thank you.
Thank you, Dina. I'll just share my screen. There we are. And as Dina mentioned, if you have anything you want to ask along the way, or if you have something you want to comment on, please use the chat box. And also Dina's contacts are there. So if you need to contact her regarding anything that we're discussing today, please do so. Dina, thank you very much for inviting me along today to talk to you and those on the call with regards to universal life. And as you correctly said, creating a multifunctional solution that will help cater for the requirements of high net worth individuals today, whether it's making sure their legacy goes to their families or overcoming some of the challenges such as forced heirship that today provides. I'm going to take up about 20 minutes, 25 minutes of your time. And I think I would start just by introducing myself. I've been in this industry, in the financial industry, for far too long, a very long time, since 1987. And I was with Lloyds Bank, I was with Scottish Provident and a few other companies as well. But at the moment, I'm with a company called CFS Continental, and we provide support and solutions to our key accounts and partners around the world, of which Holborn is right up there. So it's my absolute pleasure to be able to support Dina today so that she can provide you with the most appropriate solutions as and when. We're into the space of togetherness. We don't deal with any egos or hierarchy. We just want to be able to provide Dina and her colleagues with the best possible support and solutions. And alongside me, I have an amazing team. It's all very well having the fastest car in the world. You don't have the team to make it happen. It won't move an inch. So I have a very good team around me to support. So let's talk about universal life, how it works, who it's for. And essentially what we're looking at is, what is it? Who is it for? And probably how it differs from other types of insurance. Because, I mean, let's face it, insurance is quite a boring subject. But nevertheless, it is essential. It is a utility. It is a moral obligation for anyone who has a business or a family to ensure that those that survive them can carry on with their life in as normal and stress-free type of way as possible. So I'll be unraveling how that works. And then we'll talk a bit about the solution providers as we go along as well, together with how it works and some examples so that you can see for yourself just how different it is from your perhaps preconceived ideas of insurance and how it might slot into the world you live in. So first of all, what is it? Is it an investment? Is it a protection solution? Well, it's a bit of both. And as we've touched on, it's a multifunctional solution for high net worth individuals seeking a combination of both protection for the rest of their life, which we call whole of life, and there is an investment component as well. So it allows them to see some growth. Most of us think of insurance as dead money. which is ironic, really, because it's dealing with people when they have died, whereas not here. So the first thing I would ask you to do is replace the word premium with the two words working capital, because it's actually going to be working for you in a number of ways. And we're looking, going from the left there, first and foremost, to protect and secure, but also to address any retirement shortfalls there may be, deal with estate planning. Dina touched on forced heirship, so that you can channel the payout in the right direction that you want it to be, and not be beholden to any local rules or requirements. And then last of all, we love our children. We want them to get the best education, so it can create a pot of money while still giving you the protection you want, but at the same time being dipped into to provide for educational costs, for example. Who is it for? So essentially, it's for high net worth individuals. Now, that may be just simply very, very wealthy people, but also business owners. And again, as Dina's touched on, this is very, very useful for people that want key person protection. In other words, they want business continuity. They want to allow their business to continue following the demise of a key director or a father and son, so that the business can continue, the competition keeps away, the creditors keep away, and life can continue in as normal fashion as possible. And I've got a great example to show you as we go forward with a father and son. And then people with illiquid assets. So they may be heavily invested into property or into their business, but they want to make sure they stay intact in the event of someone passing away. So very, very flexible. So these are some of the key reasons why I might use universal life in this case. So essentially, it keeps rich people rich, whether they are business owners or whether they are successful entrepreneurs. And as we'll go along, we'll look at some examples. So timing is very, very important. So my first example is meet Hashem and Talal. Let me just, sorry about that. So this is a father and son. They're running their own business. And in this case, they're based in Jordan. That's not really them, by the way, but we're just using them as an example. So in this case, the priority for the business is to ensure the smooth succession for the business for the son, Talal, in the event of the death of Hashem. Building a retirement fund as we go along, having that business continuity so their business can stay intact, and being able to gift this to Talal's family in the event of death. And it'll all make sense as we see some numbers, but providing that protection. And what's more is protection and peace of mind. As I said when I started, insurance is quite a boring subject, but we do want to sleep easy, and we don't want the worry of losing someone as and when. We don't time these things particularly well. And I think particularly after the global pandemic, we've probably all been touched in some way, whether or not we've had COVID ourselves or we've had someone that's been very ill or worse. I'm lucky enough, I don't know anyone close to me that's died, but I had a friend who died and he was younger than me, leaving behind 3 children. So we've all been touched in some way. And we'll talk about how it works as we go along. But here we've got an example, and I'll tell you exactly how it works. Here we have an example of a $10 million case. In other words, in the event of death of an individual, $10 million would be paid from the insurance company to the estate, to the beneficiaries. And one thing you should notice straight away is Mr. Hashem is 61 and his son is 31. So the benefit of timing is to do this sort of arrangement while someone is young. Or if you are running a business, ensure the patriarch, but also the juniors coming through the ranks who've been to university and are now gradually growing in the business, ready to take on the baton, to take over the business in times ahead. For Hashem, his premium would be $3.4 million, single premium. But I want to just draw you to this bit here, and we'll talk a bit more about how the growth is achieved. But we'll just look at these numbers now. After 10 years, the value, the cash value of his plan would be $3.9 million. Again, think of it as working capital. So that 3.4 hasn't been spent. It's just been put somewhere else. And we'll talk about the providers as we go along. So essentially, all the while from the moment it's been put somewhere else, Hashem is covered for $10 million if he dies, and he will die. But we just don't know when. Conversely, Talal, who's significantly younger, his premium is much, much less because he's only 31. So by making a good plan ahead of time, we can see that after 10 years, again, similarly to his father, his pot is bigger than what he put in. So all the while they're protecting themselves, the business, their families, and essentially that's how that works. Now, I want to dig a bit deeper into how it actually works as we go through our presentation today. Everything is written within the framework of a master trust, again, which Dina quite correctly touched on. And a master trust, if you think of the phrase, the best plan is the one that pays out the most when it's needed the most. And in this case, it's needed the most when someone passes away. It can be dipped into at any stage, but essentially, if someone passes away, we don't want to have to go through the courts. We don't want to have a will contested. We want it to be a smooth transaction between the insurance company, who've now got a death certificate, and the beneficiaries. And it's done by way of a master trust, which completely avoids the necessity for probate. And the nice thing is, it doesn't cost anything. So you have a client here, they have a policy that's held into trust, and within the trust, they have a letter of wishes. So for me, my wife is Claire, she'd be my primary beneficiary, and my children, Esme and Matt, would be my secondary. So that if Claire and I passed away together in a car crash or whatever may happen, it means that they will get the money straight away without any necessity for probate. So how does it work? And I've deliberately put those numbers at the beginning of the presentation to grasp your intrigue, let's say. So I want you to look at this very nice diagram, which is one of my favorites that I talk about. Why? Because it's very easy to explain and remember. There are various things happening here. So let me talk about these. And if need be, we can go back to our example. We've got premium here coming in from the left-hand side. Everything is US dollar based. That could be an annual premium. It could be a single premium, as we saw with the example we've just had just now. And that's going into what's called the account value. And from the account value, we have this drip into a very small glass, which is called the COI, or the cost of insurance, often referred to as the mortality charge. It's the actual cost of insuring Talal's body in Jordan in that instance. So it'll vary by someone's gender, their age, their smoking habit, where they live, if they get up to any pursuits like scuba diving, for example. But the interesting bit is the profit. Where does the profit come to? And I want you to think of a segment. What is a segment? A segment would start in this instance, what are we, the 5th of April, 2024, on the 15th of April. And the company that we're talking about, and we'll go into in a second, would look at the position of an index like the S&P 500 from the 15th of April this year to the 14th of April next year. And that is the segment. And they'll say, what did it do? And if it did 8%, they will pour 8% into this bucket here. And that's how the growth is arrived at. But importantly, when the market goes up, the segment value goes up. But when it goes down, it doesn't go down. The segment value doesn't go down. So what you're able to do with the growth component is massively reduce associated risk to the point of you make money in a growing market, but you don't lose money in a declining market. Now, we see a lot of things in this world today which are catastrophic. We've had the global pandemic. We've had the terrible situation going on in Gaza just now. We've got the Ukraine situation just now. We've got a presidential election this year. Lots of things that can affect markets. So if you can find a way to A, get your cover, and B, find a channel to get it where it needs to be in the event of death, and the growth component can be managed on the downside, I would suggest that's a good thing. Let's talk about the solution providers. So we've got two there, and the one on the left is Manulife. Manulife, it was established over 120 years ago. Both of the companies are Fortune 500 companies. Both of them are Canadian based for their onshore, their North American business, and their offshore business is run out of Bermuda, which is a very well established offshore financial jurisdiction with great policyholder protection. So along the way, you know that you're with one of the best in the world. And secondly, that your money is safe. And your money never hits the shores of Holborn, and it never hits the shores of me at Continental. We are here talking about it as mediators to make it happen. So let's look at Manulife to start with. We've talked about that already. So very high credentials along the way. In terms of acceptance, they will take business from over 150 countries around the world, and it's all determined by where the client lives. And their minimum in terms of protection is $2 million. It's more expensive for a smoker, as you would expect, because the risk of a smoker dying is higher. In terms of the growth, we're going to look at today, just purely because of time constraints, at the performance index account. Very, very straightforward. And as I've mentioned to you, it is tracking the S&P 500 on that segment basis that I mentioned earlier, point to point. What it does in between is irrelevant. So in other words, if a market goes up by 10% here on the bottom left-hand side where my cursor is, the client will get 9.3. Why? Because there's a market cap. So if the market goes up by 10, they get 9.3. But here's why I particularly like this angle. They guarantee an additional 15%. So in actual fact, the 9.3 is increased to just over 10.5. And that's the money that's added to the bucket. And then it starts again for the following year. Equally, if the market goes down, you don't lose money. In fact, you accrue 3% growth in those difficult years, which you get when you surrender the plan. So, and at any stage, you can dip into the accumulating pot, as I mentioned earlier, for retirement or educational planning. So it's very, very simple, very straightforward. And all the while, if anything happens to a client, there is a huge payout. So let's put some numbers on the door. So here we have someone who's a resident in UAE. He's doing a case for $5 million. In other words, in the event of death, $5 million would be paid out to his estate via the master trust. So in this case, this person's decided, I'm going to pay for it for 15 years. Why? I want to get the cost out of the way. So by the time the client is 55, he's still covered until he's 121, which he won't make, to be honest. So he's covered to the rest of his life, and no more premium working capital is required. So total capital outlay here is $799,000. And we can see by year 20, the bucket, the account value, is significantly more. So literally, the money is going from here to here, and in the middle, they're being covered for $5 million along the way. And the performance index account is how we do it. And we always assume a very conservative growth rate with the S&P 500. Why? Because it's better to undermanage. It's better to manage expectations by underperforming than overmanage them by promising a higher rate. Now, I know, because I talk about this all day to my partners around the world, the S&P 500 since 1957 has delivered an average performance of about 9 or 10%. So by illustrating 6.3, we're being uber conservative. And it may be 2 years, 3 years down the line, a client says, I can't afford 53,000. Could I put in 40,000? And they will simply look at the pot and say, yeah, you can do that. So solution B, so that's Manulife. Solution B is Sun Life. Again, why would you compromise with an insurance company when you can go with the biggest and the best companies in the world? And the difference here, and it's virtually identical, the difference here is that it's a $1 million minimum face value. In other words, the protection component only is $1 million. Now, the biggest case we've done, as far as I'm aware, is about $120 million for an individual, and the average is about between 2 and 4. So this is coming in on the lower side, US dollar based, as I mentioned. And here it looks very similar. because these people all live on the same island in Bermuda. Some of them have worked for each other. They're not quite at each other's throats, but they're very, very competitive, which is good for us because it means they put a lot of work into making products competitive. The balanced account works very, very similarly. Looks familiar, doesn't it? The investment component, again, S&P 500, well-established, great track record, downside fully protected, and the upside cap, in other words, when the markets go up, is 10.25. So if a market did 15 in a year, the client will get 10.25 added to their investment component with an illustrative rate to manage expectations of just over 6.3 once again. And the numbers are very, very similar. So now you can see, I could show you an illustration, but I think I would bore you all to death because it's 15 pages long. So what I always do when I provide an illustration for Dina and her colleagues is provide the illustration with a one-page that captures all of the key numbers. So in this case, a $5 million case for 15 years of premiums is looking at $55,000 per year. And further down the line, all that money is recouped. The cover is guaranteed until age 74. So what does that mean? That means in the event of zero growth in the S&P for, in this case, 34 years, the client would still be covered. Whereas with competitor products, what's called unit-linked whole of life, they would be reviewing the growth component to make sure there was enough money there. And if there wasn't, after 5 years, they would ask you for more money, which isn't ideal. And the other thing I'd like to draw your attention to is at age 100, it does what's called endowing. What does that mean? It essentially means that the value of the accumulated pot of money is the same as the level of life cover. And that kind of makes it a bit more interesting. So, dead or alive, you're worth $5 million at a very low growth rate. In terms of the information we require, I provide quotes and illustrations to Dina. My team is amazing. And I would say that, of course, wouldn't I? They will provide that. So we just need details of the name of a client or their initials, the level of cover they're looking for, the date of birth, gender, because women outlast men, as you probably know, the country of residence, and the nationality, if there are multiple passports in particular. And then, does someone smoke or shisha or vape or cigars? That all counts as smoking. And then, very importantly, any existing preconditions, e.g. diabetes, hypertension, because the process involves 4 things: health, wealth, lifestyle, and professional journey. So health is easy. That's just a medical, which we pay for. Lifestyle is what does someone get up to? Do they go base jumping off a tower in Dubai, or do they just lie on the beach? And wealth is an overview of assets, both in terms of cash flow, debt, and also ownership of things like shares and portfolios, etc., so that we can ascertain this is the right solution for this particular client. And then professional journey. How did that person become an owner of an IT company? What was their professional journey? Which allows us to work with our partner, Dina, so that we can position and get the best possible deal for our clients around the world. And then in terms of support, we have a very nice process, and I won't talk you through everything stage by stage, but essentially you are in good hands. Think of it as a guardian angel to guide you through the process to make it happen quickly and efficiently so that you can protect your loved ones, you can protect your business, you can allow life to carry on and enjoy life now, knowing that this plan is working in the background for you to cover every eventuality, whether it's death, but at the same time, on a more happier note, to grow so you can dip into that along the way. So that, my friends, is Universal Life, and I'm on about 22 minutes. Dina, I'm very happy to answer any questions that you may have or that your guests may have today. But I'll hand back to you if that's okay.
So basically, in a nutshell, what we've come to learn from this presentation is that this is a way through the Index Universal Life where you can create a large cash value portfolio, yet at the same time have the protection included. And if I were to describe it, there are two cases. If in the case of death, you have the master trust, which will pay out to your beneficiaries a predefined amount that you have set at the onset, be it $5 million, $10 million, etc. And if you are alive, you also benefit from the cash value buildup that is mirroring the S&P 500, that is locking the upside of the S&P 500 and protecting against the downside. And I believe there is also one more feature which we haven't touched on, which is the possibility of taking on income from year 11, correct? Richard, correct me if I'm wrong.
Absolutely right. Yes. So you can take withdrawals penalty-free from year 11 onwards. So it can almost be like a retirement plan.
Exactly, as an annuity. So I believe this is a great solution for many situations, many cases, for people who are looking to establish something, to get away from forced heirship concerns in certain countries. It is a way to protect themselves in terms of their businesses, if they want to pass it on to their children, if they want to do something on behalf of their children. And you've drawn the examples of Mr. Hasham and Mr. Talal and the power of timing. So Mr. Hasham was able to do something for Mr. Talal, his son, and benefit from much less working capital as opposed to higher working capital for him at the age of 61. It's a great solution. Honestly, it's a great solution. Thank you so much, Richard, for being with us today.
Great pleasure. And thank you for inviting.
And if there are any questions on your part, dear participants, please be in touch with